Reading economic forecasts can feel like reading tea leaves. BNZ's chief economist Mike Jones joins us today after releasing his recent analysis, Year of the Refix, which offers a fascinating look at the current financial landscape. Mike Jones has had senior roles at both the Reserve Banks of New Zealand and Australia, and also had stints at Westpac, ASB and Fonterra. Mike, you've highlighted that 81% of New Zealand mortgage borrowings will reprice in the coming 12 months. What are the potential risks and opportunities this presents for the New Zealand economy?
Yeah, thanks, Andrew. Interesting time to be having the year of the refix, because obviously we're starting out in a year that looks pretty uncertain, pretty choppy. We're getting daily headlines coming through with potentially big implications all the time. So I think, first of all, the context of this big weight of mortgage maturities that we've got is important. It is pretty crazy time. And yeah, there's some risks and there's some opportunities. I think the note I wrote was really about getting across a couple of points. The first is obviously with a lot of people running a short-orientated mortgage strategy, i.e. borrowing for short periods of time or floating, you've got a little bit more risk about future interest payments than otherwise. And the second is around the role of expectations, because we know there's a lot of expectations built in around mortgage or interest rate cuts this year, official cash rate cuts. And so we've got this sort of oddly shaped, in some sense, mortgage curve where people are paying a bit more upfront to stay in those shorter terms, those floating terms and those 6-month terms. But you've got those opportunities from lower 6-month, 1 and 2 year rates. But it also means that I guess the hurdle, or particularly those longer term rates to keep coming down, is higher because you've already got those expectations built in to the curve. So look, it's all setting up a pretty interesting February meeting from the Reserve Bank, where we're expecting another 50-point cut, but I think there'll be a lot of interest in what they say about the future, and a lot of people tuning into that meeting as well because of the extent of those mortgage maturities we've got this year.
Yeah. And I suppose that an important part of the statistics that come out of these business confidence surveys and how people are feeling, it's like an indicator of how small percentage of the market, like when they do a survey of 1,000 people, they get a pinpoint on how people are feeling. But when you look at the whole market from the actual data, you can actually see what people are doing with their actions. And I suspect that people are feeling like there's a lot of uncertainty, and that's why they're doing that short term. And then when you see surveys where business confidence is up and things like that, that's okay to take it with a grain of salt, because this is actually how people are acting, right?
Yeah, it's a funny time, because we're probably at the turning point in an economic cycle, but it's also, I think, hard to get your head around, because in the one sense, people are not feeling that much better, say, than they were 6 to 9 months ago. The actual hard economic data that's coming in hasn't improved a whole lot either. We're still kind of mired in this slow and low recessionary type environment. What has changed are the expectations. So if you look at some of those business confidence surveys you mentioned, even consumer confidence now, they've jumped up a lot. So in the here and now, people aren't feeling that much different. Don't think the economy is really improving yet, but there's a lot of change in expectations about the future, which I think largely relates to lower interest rates. People have seen these interest rates come down. They're thinking, well, that's going to help me. That's going to help the economy. That's going to help business. But it hasn't actually happened yet. And the interesting thing to me is when you look at the data, it says people haven't benefited from those lower interest rates yet either. What they've tended to be doing, as we've talked about, is actually rolling up to floating to retain that flexibility to try and roll on to lower rates in future. But what that means is you're actually paying a rate that's not too different from where you might have rolled off. So you're actually postponing the benefit of those lower interest rates into the future. So we kind of know those better times are coming, but they haven't actually turned up just yet. It's a story for probably later in the year.
Yeah, and if you've been wearing that extra cost for a few years, or even in the last year, and you've essentially been going backwards, but you've been keeping up with the repayments, even if you get that lower repayment now from the lower interest rate for the next year or two, It might be that you've taken extra secondary debt to cover those shortfalls, and you're going to use this now extra surplus to pay that off. So, in terms of extra spending power, it might not actually come into the consumer spending. Well, people have been swimming in that extra debt, and I see. No, one of the interesting things from you guys' report was this interest expense under alternative fixing scenarios. This chart, and it was a really good illustrative kind of point that you're making, is that this short term fixing, when these lower 1 and 2 year rates are available, it's actually not saving you anything to get this lower rate when you're exposing yourself to that extra risk of being floating or having the uncertainty. You want to talk around why the psychology around this?
Yeah, look, it's a simplified example, and I won't go through the details. Not that there are a whole lot, like I say, it's quite simple. But what it basically says is, and actually, I did it because I was getting the question so much, right? Like we've talked about the data, but actually, I barely sat down on my desk start of this year, and 4 or 5 people have said, "Oh, what do you think about different terms?" And it does seem like it's a question on a lot of people's minds. And me being the sort of numbersy, painfully kind of rational person, I put it all down on the spreadsheet, see what it looks like, right, for the scenario. If you fix today for 2 years versus if you fix for 6 months and just rolled 4 times, 3 or 4 times, and you've got to put in some numbers, some hypotheticals for where 6-month rates go from here. Obviously, if you fix the 2 years, you know what you're going to be paying for those 2 years. And people did like it. I mean, I've had the feedback, because it does actually show you that to motivate, at least from a financial perspective, fixing for 6 months, you do need to see those 6-month mortgage rates drop quite a bit from here to break even on that scenario against the 2 year. And also on the 2 year, you've got the certainty. You've made the fixing decision. You know what you're going to be paying. You can kind of rest easier. Whereas in those 6 months, you're kind of riding the market a little bit more. So it doesn't kind of lend you one way or the other, but it does lay out, I guess, the cash flows. What you're looking at and what you need to be seeing to break even on that shorter term type scenario.
Yeah, the benefits of certainty definitely. There's a value to that. So I appreciated that chart. Another one I thought was quite good to look at was the share of mortgage borrowing within the remaining term of under a year, and you can look back over the decades and can see that there's been a lot of volatility in how New Zealand borrowers have felt about fixing and borrowing for longer terms. I can see that things are still trending upwards. Are we expected to see that peak off sometime soon? Or certainly with what is going on in the US, seems like uncertainty is still going to be the name of the game. Even in the last 24 hours, there's been some pretty big movements in the share market.
Yeah. I mean, look, that rush into those shorter terms has become a stampede. That's basically what the chart's showing you. 81% of all borrowings will refix over the coming 12 months. And we haven't seen the mortgage book that short for about 13 years. So, look, some of it's expected. We've talked about it, I think, last time, where, the outlook for interest rates is for them to keep falling in the short term. The Reserve Bank's going to keep cutting the cash rate. Given that, all makes sense to stay short and get the benefit of those lower interest rates. At the same time, I think what stood out for me in the November figures, and so November's the month, the most recent bit of data we've seen, 94% of all borrowings in that month were for terms of 1 year or less, and about half were outright floating. So, like I say, it's become a bit of a stampede, this rush into those shorter term rates. I might have expected a few more people to have, at this point in the cycle, just started to pick up a bit more of those longer terms, but clearly it hasn't happened to date. So that's, I guess, goes back to, well, what we see from the Reserve Bank over the next couple of meetings. Do they keep saying, yep, we're cutting rates and we're going to keep cutting aggressively? Or do they start to say, look, we've done three what would be three or four 50-point cuts, and we're going to slow the pace of future easing? And that might be the point at which people start going, well, hang on a minute, should we start to look at some of those longer terms and term out some of that debt? But certainly, we haven't seen it today, at least in those public figures you talk about.
Yeah. And what do you think is going to impact us the most? What's going on in the US, or does that just get overhyped and actually it's more important what's going on in Asia or Europe? And Trump might get the headlines, but does that actually impact little old New Zealand that much?
Yeah, it's a really good and tough question, actually. I mean, I guess what we're seeing at the moment in the US is headlines near constantly, and also some of those headlines changing on a nearly day-to-day basis. So definitely wouldn't advocate following all of it. And look, whatever happens in the US will still affect us to some extent. So it's not that you can completely ignore it. A good example would be the interest rate cycle in the US. Now, that's shifted quite a bit, probably just in the last month and a half, where US Federal Reserve is now going to cut maybe once. Some would say twice, some would say no more times this year, right? So that will impact us if that's the case, because we'll see a bit of less downward pressure on our longer term wholesale interest rates. Might see a bit more downward pressure on our currency as a result. So there's definitely implication. I still think, and I make this point, and New Zealand is sufficiently different that it's not like we just sort of follow the US one for one, right? We've clearly got an economy that is nowhere near as strong as the US. We've got a much stronger case for lower interest rates here, so we can still kind of separate ourselves and our interest rate outlook as a result. But I mean, I think the key for me is, if I really try and succinctly answer the question, is the impacts on China. China's our number one trading partner, and if we saw some particularly onerous tariffs imposed from the US on China, such that it really affected Chinese trade, China's economy, well, that would clearly have some negative impacts on us here in New Zealand that would really matter for our economy. So that's probably the most important, I think, channel to have a look at. But we're probably not going to get real firm steer on that, in the short term. We're just going to have to see how things evolve on that front, because the narrative certainly seems to be changing around a bit day to day.
Yeah. I mean, I haven't got it printed out, but from your report, I very distinctly remember that sales seems to be the most challenging thing when business owners are surveyed at the moment, and I think a part of that is because people are struggling. They're pricing things at very low margins, and it makes competition that much tougher. And it certainly feels like a lot of our key industries are still hurting, and it becomes this negative cycle where making investments and taking risky, putting money into a risk, people don't do it. They just stick to the business as usual as much as they can. And I certainly am worried if the Reserve Bank doesn't keep dropping rates like everybody hopes, and things just stay flat for a long time. I see that. I remember reading that BNZ is actually projecting out into 2026 that rates, they go down through 25 and then up again in 26. So you average it out, it's a period of flatness.
Yeah, look, I wouldn't read too much into that, other than to say you have to build in some expectations that interest rates start to rise again out the other side, whenever that may be, right? So interest rates move in a cycle. We're clearly in the down cycle. We think we've got a wee ways to go on that just yet. But at some stage, whether it's 26, 27, we will see the other side of that cycle. And so that was our attempt to sort of build that in. You can't just say, well, interest rates are going to fall, or the official cash rate is going to fall to some neutral rate of somewhere between 2.5 and 3.5 and stay there indefinitely. I mean, that's, there is going to be a cycle.
It would be nice, yeah.
It would be nice for some, certainly. But look, like I say, the economy will improve. No one knows exactly the timing, right? We seem to be at a bit of a turning point at the moment. Economy will improve. We'll get that growth momentum coming back. I think firms will start to invest again. And you move through a typical economic cycle, which at some stage demands higher interest rates. We're certainly not kind of thumping the table on when that might be, but we are in our forecast out in the long term building that in. But I think at the moment it is this uncomfortable position where most people think we'll get a better year this year, and there's some really good reasons to expect that. We've got a really low currency. We've had interest rates come down quite a lot. Our export sector, parts of it, particularly dairy, are doing particularly well. So you've kind of got the building blocks, and people like me talk about the building blocks, but actually on the ground, I don't think firms are really seeing it just yet. It's all there, sort of in the expectations and in the forecast, but it's probably not being felt on the ground. And as you said, one of the things I'm looking at this year that does need to change if you want to have an upswing is profitability has to improve, because at the moment profitability from firms is really stretched. That margin pressure is tough, and we know that firms don't invest and they don't employ when the bottom line is in the shape that it's been in, and that's something that's yet to turn. So that's something I'm going to be watching and talking to firms a bit about in the next wee while.
Yeah, I look forward to see what you guys cover over the next couple of months. It's funny that we're somewhat critical of people refixing for short terms, and especially in such big numbers, like shown on this chart. You can see that the recent figures is shows double amount of short term refixing than we've seen in the years, in the months prior and the years prior. And what we're saying is, hey, rates are looking like they're going down, but even though they are going down, don't refix for short periods. Use intelligent interest rate averaging, because if they go down even further, you'll miss out. If they go up, and I always try to say, don't try to make money on your interest rates. Try to protect yourself with interest rates and make money with smart investments and good buying and selling decisions. And it is a funny old time. And what are you guys covering over Jan, Feb, March? You got those focuses lined up, or?
Well, I mean, part of it, we're not going to be able to get away from talking about what's happening in the US and the risks there, on both sides. So that's going to be a part of it. I mean, normally this time of year, sort of get out and about a little bit more and go and do some presentations and talk to business, because we're always pretty keen to hear what people are interested in and what we can look into. So that's basically where the idea for that note came from, is talking to a few groups, and that question, it always comes up, mortgage fixing and so forth, but much more than usual. And then you look into the numbers and you say, oh, okay, yeah, 80% are due to refis. So yeah, well, I think I'll look forward to getting out there and seeing, what firms are interested in. I mean, it's that turning point again in the cycle. And I think what I'm getting at the moment is people want to know, okay, well, it seems like we're past the worst. We're going to pull out a recession in the next few months. Which sectors, which areas of the economy are kind of expected to drag us out, do well, and which might lag, and how do we position ourselves for all of that? So it'll be I think a bit of that. The sectoral type stuff always seems to be of interest to people, not just the macro numbers, but which sectors and which regions.
Yeah. Well, thanks for joining us today, Mike, and hope to catch you again soon.
Always a pleasure. Thanks, Andrew. Thanks for inviting me on.
Cheers, man.